Welcome back to Investing and Trading Live. As always, my name is Josh Littlequist. I have my good friend, my good pal, Al, here with me today. And he is not the pumpkin patch, not the cabbage patch kids, but he is the one and only, the stock master, having a good time and just enlightening our listeners and dropping some knowledge on the stock market, but also on different assets as well. Options, futures, Forex. We had cryptocurrency, Bitcoin surging this week, so a lot of great opportunities, and that's what we're going to continue this discussion on, is the opportunities that we're seeing with your retirements, wealth accounts, you can call them wealth, whatever, long-term investments, whatever they want to be called, that longer term for those golden years of your life. And we had a lot of people texting in for that investing class in the last segment. Congratulations to those that did get seats to this investing class. If you missed it, simply just text the word investing to the number 210-210 for 2 seats for an investing class, one for you and one for a friend, or simply go to investwithota.com for your seats, and you can pick your own date. Make sure to subscribe and like the podcast wherever you listen to podcasts, Apple Podcasts, iHeartRadio, and Spotify, Investing and Trading Live. So, Al, in the last segment, you talked about a few different things. Why people are coming into these investing classes, what's some of their motives, their goals, their objectives. And part of it, you said it was increasing income. So we talked about those strategies in that last segment. There's strategies with different assets, including the stock market. But people are looking to increase that because it's not getting any cheaper to live. But people still want to have that freedom of time to be able to do things that they want to do. That goes hand in hand with protecting your assets, which would be your retirement accounts, protecting those 401ks, protecting those IRAs, people that have been able to save up a significant amount for their wealth accounts, and they want to continue that, and they want to keep what they have no matter which way this market goes. We kicked off the whole show with offense and defense in sports, and the same thing is the markets. Markets go up, markets go down. There are ways to protect it from going down. And I just want to clarify that. People say, when you hear people talk about it, oh, markets go up, markets go down, I'm in it for the long haul. Well, why would you lose in down markets when you don't have to? There are ways to protect that. And I want you to discuss some of that here on this segment. Is what are some different strategies or assets that might be designed to protect your monies during those down markets, but also being able to grow that in any direction, up, down, or sideways?
Yeah, there's a number of things you can do. We talked about options earlier, and the fact that options really were designed as a risk hedging strategy. If used properly, that is the case. You can have a defined risk, a small amount of risk with potentially unlimited upside, or I should say unlimited upside potential. There are things that you can do, probably not in a 401k. There's some real limitations within unfortunately, the go-to retirement strategy for most people. What we would say is that as soon as possible, if you can roll that 401k money into a self-directed IRA, now you have the ability to have great protection on your assets. You can use stop losses. You can use options as protection. There's an option strategy that actually acts as an insurance policy on your portfolio. You don't have to sell anything. You can have a portfolio of stocks that you love, for maybe they're kicking off some really nice dividends. Maybe you worked for a company, you don't want to sell that stock. You don't have to do that, but using something like options in addition to that portfolio allows you to have it protected. So the stock can go down in value, but your overall portfolio doesn't.
It's kind of like having an egg, Al. I mean, eggs can be really messy if you get them on the floor, right? Okay. Say you drop an egg and it gets on the floor. It's very greasy, very slippery and everything. And even if you wipe it up, it's going to be slippery, especially if you have like a hardwood floor or laminate floor. So basically, rather than just letting that egg fall, maybe put a towel in your hand quickly and catching that egg. That would be stopping it from that catastrophic ending. That's the same thing with your retirement accounts. Did I paint a good picture for you?
What must it be like to live in that head? That is true, though. You want to protect your floor from those eggs. But protection is the number one thing. And think about this for a minute. How many times when you have gone into a financial advisor, or when you did go into a financial advisor, someone talked to you about your 401k, did they talk about the 3 components of investing? What are they? And this is in order of importance. Number 1 is risk management. Number 2 is market timing. And number 3 is allocation. And I know some of you say, market timing, you can't time the market. What we show you with a strategy we have, a core strategy, is how to time entry and exit positions for any investment that you're going to be making.
Here's an example that I just want to clarify as well, and I got some examples. It's not about an egg here today, but I have a 6-year-old, and he's learning how to read and write and everything. I can't learn how to read and write. I said, yes, you can. You just haven't been taught yet, and it takes a little bit of practice. And that's the same thing in the markets. You can protect things. You can have strategy for down markets. You just haven't been taught yet.
Yeah, and why haven't you been taught? Why haven't people taught you how to do those things? It's because that industry, Wall Street, needs people to need them. And they'll tell you, and if they talk about protection, by the way, this is what they'll say. We will have you diversified. We're going to have you in a diversified portfolio. That is going to provide protection. But they also, usually in the small print, it says, but diversification cannot prevent loss. Maybe it mitigates it a bit, but the way they have you diversified is to have a portfolio of stocks or a portfolio of mutual funds. That's all the same asset. That's not proper asset allocation.
Well, what if the stock market falls and you're still in all different stocks?
They all have the correlation becomes extremely strong when the market is crashing. You go into
So they all go down then.
You might have the best company in the world, but it's probably going to go down with the rest of them. It's sort of like a bathtub. If you pull the plug in a bathtub, all the water gets sucked out. You can't point to a portion of it and say, "Don't go down."
So to clarify, then you're telling me that if people are being put in a diversified portfolio with energy stocks and financial stocks and all these other stocks, and the stock market goes down, they still lose. So
they can lose, yeah.
So that's not diversified
no,
then.
The correlation becomes strong.
So how do you diversify yourself?
Well, think about this also. If you are diversified into, let's say, the S&P 500 is made up of 11 different sectors, economic sectors, and if you're invested in all 11 of them, are all 11 of them going to be outperforming or underperforming?
It's never going to be exact.
No, some will be outperforming, some will be underperforming. So you're in both. You're always going to be in something that underperforms, something that maybe outperforms. But however, like in 2007 to 2009, all 11 sectors of the S&P 500 were down. But they're all equity related. So by having a proper asset allocation, we're talking about things like maybe some stock, maybe some bonds, individual bonds, maybe some currencies, maybe some precious metals, maybe some real estate investments, a number of different things that are not necessarily correlated, and in some cases are inversely correlated. Everybody should have an asset allocation that is specific to them, though. It's not one size fits all is not accurate in the financial markets. You need to look at what you want, what your goals are, what your needs are, really what your psychological makeup is, because some people are more willing to take, let's say, make investments in something that might be considered a little more risky. But again, we're going to show you how to control that risk, because there's no reward without it. If there was no risk in the markets, everybody would just be making a couple percent, and there wouldn't be any high moving investments. So learn the different investments that you can have put together in a portfolio that will give you proper asset allocation, have protection, and then when you get into something, the time has to be right. You have to be able to time when the price is going to move in your direction. When you go into a financial advisor with, let's say you came into $100,000 or $200,000, and you go into the advisor, they're going to say, we just need to get that in the market so you don't miss the big days, up days. But what they don't say is, well, you're also going to miss the big down days, so you have to be in for the big up days, so they offset each other. But they don't take into consideration price for the most part, and price is the most important thing. Getting in at the right price will also help you to have a high quality risk management strategy, and also help you to be able to achieve the greatest amount of profit in an investment.
And in one word, Al, who has your best interest in your money?
Well, that would be you.
Exactly.
So yeah, just look in the mirror. That's who your best friend is as an investor or trader, or your worst enemy.
Yep, and somebody else is not going to. Well, let me reframe that statement. Somebody else is not. You don't want somebody else dictating your future. And that's what we're seeing a lot of people coming into these investing classes want to do, is be able to take advantage of the opportunities and not be stuck in status quo. And that's the problem, is people are in status quo. They don't reach the goals that they have because they rely on somebody else to do that. Well, Al, if you relied on me to make sure you dressed up, you wouldn't be wearing that beautiful orange shirt today. So you'd be looking actually much funnier if I had to, pick your clothes out.
It's a ragged T-shirt and a...
Pretty much stuff you wear every other day that you hear, right? But that being said, take advantage of these opportunities. They're out there. You just haven't been taught. They're not new. They're just a little bit different. Text the word investing to the number 210 right now for 2 seats for an investing class, and we can introduce you to these techniques and concepts to help you get started if you're brand new or if you've been investing for many, many years and you want more consistency. Text investing to the number 210 or simply go to investwithota.com. Al, we got one more segment to go, and I want to talk about ways to get out of that status quo mindset and how to help people get into that abundance mentality. Coming up next. We will be right back.